All right. Perfect, everyone. Thank you for joining. We'll go ahead and get started here to make sure that we can make the most of our time. As you are aware, we have a very, very, very special webinar this week, and for this installment, we're really excited to go through with everybody here what we have lined up. I think that from multiple perspectives, a lot to be learned in this webinar in particular, and continue sort of building into the future here. A little bit of an update as well before getting into the intros and kicking things off here. We will actually be making this the first installment of the LiveFlow CRI Simple Numbers webinar series, where we're really taking a deep dive into the template, shared workflows, shared notions of how to operate in these templates, and just making the most of these workflows as a whole. So I'm really excited that everyone here can join for the first one. We'll make sure that everyone here gets a link to be able to RSVP for the ensuing webinars from here within the series. So really excited to kick this off. So with that, I will go ahead and get into a couple of intros here. I think that for the most part, a lot of this doesn't necessarily need a lot of intros here, but let's start with Greg. I think everyone here knows Greg. I'm fairly new to this accounting space over the past few months, and very early on, I learned that Greg is an absolute legend in the space. So really happy that we can have him on today and just dive into a lot of these learnings that everyone knows is so incredibly valuable. But again, Greg has over 40 years of experience that we all are aware of in this space. Very well recognized, as we all know, as a public speaker, an author, entrepreneur. We know that the Simple Numbers program is an incredible value add to just the accounting industry in general, and it's helping people every single day. I know that a lot of our mutual clients and LiveFlow customers in general really lean into this notion and this frame of mind to operate essentially. So we all know Simple Numbers, straight talks, big profits. We know that Simple Numbers 2.0. We know that these incredible ideas of how we can handle accounting, it's just been incredibly valuable for a lot of people. And again, we're so happy that we can have Greg and Marcus on to speak through this and really dive into a lot of the good stuff here. Alisha, for anybody who's within the LiveFlow family already, you know Alisha very, very well. She's our FP&A expert, our modeling expert, our reporting expert. You've probably spent some time with her on Zooms, building out different models, getting into the weeds of a few different things, and just stepping away in all of what Alisha is able to do. So also really happy that we can have Alisha on here with Greg and Marcus. This team built out an incredible template. If you haven't been able to use already, we're really excited to show you what it's all about today. We'll go ahead and kick it off there. Alisha, I will go ahead and pass it off to you to dive into the template and cover anything else that I may have missed there.
Yeah, of course, and thanks, Michael. So first of all, let me just drop the template in the chat for those who haven't been able to see it yet. So the full link. This is also available on the LiveFlow website as well as within the product if you are a customer of LiveFlow already. And with that, let me share my screen. Just a second. Can everyone see the screen?
Yep, we're set.
Okay, so I'm just going to keep this brief because I know everyone's here to hear Greg really dive deep into this template. So I'm just giving a quick overview, and then Greg, I'll hand it over to you to really deep dive into what this template is trying to do. So to start off with, this template was built in collaboration with Simple Numbers, and the design and methodology is entirely by them. What we've been able to do is bring all of their amazing ideas down to this template and then power it up with live data. So we'll probably come to that towards the end of the webinar, where we can see how you can use this template and scale it with all of your clients if you're dealing with multiple clients. But before that, just a very super quick overview of what the template itself is doing. So over here, we have key terms that I'm sure you'll be coming back to regularly that are used throughout this model. And we start off with a quick very simple, easy to understand dashboard. So the key thing with this model is simplicity is something that has been really emphasized, because you don't need over the top fancy dashboards to convey simple thoughts, and I think that's something that we have really gone out of our way to highlight here. So we go back all the way to 5 years, and you can keep swapping the month and then just seeing whatever data is already being pulled through from your QuickBooks using LiveFlow. We also have some graphs as well as trends that we can analyze, and I'm going to let Greg go through what all of these are saying. But yeah, essentially what we have is just a simplified view of the P&L, balance sheet, and cash flow, as well as the same on a rolling 12 and rolling 3-month basis. And all of these are in turn being powered by live data that updates automatically when your QuickBooks updates. So you don't actually have to come in here each month and paste data again and again. You just need to take time to set this up once, and we can cover how to set it up later. And once you're done with that, every month it's just going to automatically update and give you the latest info. So yeah, this is our cash flow template with simple numbers. And Greg, I'll give this over to you now.
Yeah, really appreciate it. I mean, what you guys have accomplished, I mean, we made an attempt at doing a tool like this 2 different times with plugins to either QuickBooks Desktop, and then second one we tried to do was with Xero. And we realized that we're not good at software. We're good at data and analysis. And so this is really a super exciting tool for us to make available, to a broader public, to open up the concepts of simple numbers. Because what you will see in the way the template's designed is it accomplishes reporting that is just not natively available in QuickBooks, Xero, whether, I was trying to think the other one, some of the other ones. I mean, it's just one of those that it's frustrating that even if they have report writers, the accounting philosophy of data telling a story has not really evolved much, since the beginning of accounting back in the 1400s when Pacioli invented debits and credits. So what we really kind of stumbled upon just studying data from our clients is settling on the simple number structure. So the first thing, Alisha, is click on the summary view. This is really kind of my favorite tab that I work off of. And go ahead and zoom in a little bit so that, kind of get it to where the net operating income line there is the, kind of the last line that you can see. So that'll give everybody a little bit, easier view. There you go. Stop right there. All right. So this is really kind of the critical view, because our philosophy is every month ends a 12-month accounting period. So forget about calendar year, forget about fiscal year. So that a lot of you are from Canada. You guys have a very enlightened tax system in Canada, because you actually understand the power of fiscal years that for some reason the idiocy of our US federal tax system kind of pretty much did away with, for a broad, group of businesses. And so I applaud the Canadian attendees of at least allowing fiscal years. But even if you have a fiscal year, I was talking to a Canadian client this morning that's up in Moncton, and he's got a February year end to his business, but we manage his business and his view of his data based on rolling 12s. What a rolling 12 is telling you, it's the highest form of value of financial data, because it's got all 12 months, all 4 seasons, every dog ate your homework excuse. And so when you present the data to your team to say, hey, our performance is not where it needs to be, they can't use their first line of defense of saying, oh, it's always like that this time of year. And you'd not believe how many times when we're showing rolling 12 data, somebody gives that argument and I go, it's rolling 12 data. There's no this time of year to it. I mean, and so that's the first highest form of truth that you look at. The second thing is rolling 3s. Now, rolling 3s have 2 different ways of looking at them. You have businesses that are consistent pretty much 12 months out of the year, So rolling threes become a very powerful tool to take what is the current rolling three, and you can see out there in column Q that taking the latest rolling three period and annualizing it. In many businesses that are in changing environments, the rolling three annualized is telling you the truth of where the business is today. And that's how you have to think about it. So you have a rapidly growing business. If you're looking at rolling 12s or even monthly data, you're just not feeling the true size of the business that you're at. If you're in a declining state, you're not realizing how much that you have to really adjust the business to, as we say in a declining market, if you're in that condition, you have to get profitable with what you got. And so therefore, how do I adjust the business to this new point to then reset, to then reattack the market, from that standpoint? And then monthly is the last thing you look at because it's the highest in forms of inaccurate data. Now, even the inaccuracies of a short period of time tell you something. Do I have a weakness in revenue recognition? Do I have a weakness in terms of how I post expenses? Are there some anomalies that that maybe I can spot a fraud or an inappropriate expense payment that can be mitigated by acting on it? So those are still important. But it's important psychologically to start with the most authoritative data first and working your way down to the least authoritative data. Because unfortunately, when you sit down to do your monthly financial review of your performance, the first piece of data you look at is the most impactful. And so that's why you must start with rolling 12, not with monthly. If you look at monthly, your brain will never let you get up to the rolling 12 data point. Okay. That's the reason why this sheet exists. And the nice thing about this sheet is you can roll it forward and roll it back as well. So you can change, am I looking at the rolling 12 at the end of August of 23? I can roll it back to look at rolling 12 that ends in December of 22 and look back at as Alisha said, you've got 5 years of data if there is data, if your business has been in business that long. And so this is really a powerful thing. And I can't tell you how many times of late I've had to take their model, roll it back so that they can see December of 2019 performance to give them the reality of what their business looked like pre-COVID versus how it's running now. And we've got some on both sides. They're better than they were in 19, some that are worse than they were in 19. And so it's important to context, to get outside of some of the disruptive periods that we've had because of COVID, because of just really a wild economy ride, that's been different. So you need to be able to look back at that history. Okay. Next thing is let's talk about the simple numbers structure. So the simple numbers P&L, this is the P&L structure we use for every industry, every client that we use. We just kind of fell into it. A couple of things are super important. Number one is never mix labor with something that's not labor. So you'll see 2 labor buckets, direct labor and management labor. Now, this is probably going to be some of the more challenging part for you to tag because some of you may not make a distinction between the two. If you do not separate labor in your P&L between management and direct, just put it all into direct labor for now, and you can kind of work towards fixing that in the long term. And we'll get on in a little more of this in some of the future webinars. But the key is if you, by default to direct labor, not to management labor, okay? Then secondarily, cost of goods sold represents all direct cost of materials, subcontractors, pass-through cost, because the most important thing is you'll see gross margin is highlighted in gray there. Gross margin is the true economic top line of your business. We have become a super over revenue hyped business environment. Revenue is the weakest number on the P&L. It's just a starting point for math. If I had my way, if I ran the Inc. 5000 list, I would actually totally restructure all of those metrics to where it's not about revenue growth, it's about gross margin growth. Because you'll see a lot of fake businesses in the Inc. 5000 that have big top line numbers and very, very skinny gross margin numbers because it's all about ego. Now, I can have a high revenue, low gross margin business and succeed, but I got to structure my business totally differently and think about it in a different way. Okay. So once you get those filters correct, then you get down to what we call contribution margin. So gross margin minus direct labor is contribution margin. It's what most of you are going to call gross profit, and it's what gross profit would probably be on a QuickBooks P&L in the native QuickBooks structure. Gross profit is a very weak term, and I credit Vern Harnish with this. So Vern, when I was writing a chapter for Vern's Scaling Up book, we had this discussion as I was writing my chapter, and he said, you know, I don't like that term gross profit because it's confusing, because the word profit should be reserved for the bottom line of the complete business. And I said, Vern, you know, I think that's a brilliant insight. And I said, so from that point on, I've always used gross margin to be the first step of the breakdown. And then gross margin minus direct labor, I used I had to create a term other than gross profit. So I called it contribution margin. And really, we think that makes logical sense. It is the margin that's being contributed to cover the infrastructure of your business and make a profit. So I will say that where I say revenue is the weakest number in the P&L, contribution margin is actually the most important number in the P&L. It is the output of your business engine. And so therefore, every discussion that Marcus and I have with our clients in talking about improving business performance, it rarely comes down to cutting expenses, which is the traditional accountant answer to a profitability problem. Expenses may not be the problem. I need productivity out of those expenses. So we believe expense is an input, margin is an output. And so therefore, what are the tools available? And so when you look at contribution margin, management has three responsibilities to make it move. I can increase revenue. I can manage cost of goods more effectively and reduce that cost, or I can manage direct labor more effectively to get either more output or reduce the labor required for the output that I have. I got three levers to pull, but that's the only three levers. And so management has a three-pronged responsibility, and now I have a clear number, singular number to hold management labor accountable to. And so this is really where you get into our labor efficiency ratios. You'll see on line 17, direct LER. LER stands for labor efficiency ratio. We're looking at gross margin relative to direct labor. Now, this model did not make a distinction. So like I said, we'll get some better sample examples as we get into the detail, but you're trying to look at gross margin relative to direct labor for direct LER. Management LER that you see down on line 33, that is contribution margin is the numerator divided by management labor. So the way that we look at labor, and we really believe that this is the key to business success, is for every dollar of labor input of whatever type it is, what is the output number? So don't look at labor as a percentage of something. That's a reductive mindset. We got to look at a productive mindset of labor input to margin output. Okay. When you get to the other operating expenses, these are the five buckets that just have magically figured themselves out. I mean, I can't really remember exactly how I derived these five, but they've been just spot on. We look at facilities, which is, you know, all your infrastructure cost of rent, utilities, repairs and maintenance, IT, telecommunications, all of those kind of structures. So it's not necessarily a fixed cost. There is some variability to it, but it's a functional cost. So these are the five functional areas of operating expenses. You can call it overhead if you want, but OpEx is really kind of the cleaner number. Marketing, this marketing number represents external marketing spend in a general nature, not in a marketing in a direct response approach. We actually consider direct response marketing for our Amazon resellers, our direct response. If I'm doing pay-per-click or some type of, you know, ad spend that has a 30-day or less life, we consider that a cost of goods sold. So this would be more outside marketing support and those kind of things. Management labor is all labor that's not direct labor. Payroll taxes and benefits, we don't allocate. We want those to fall in a bucket by themselves. And then the catch-all bucket of everything else is other OpEx. And so that's really the structure, that you'll go through, and Alisha will talk about how to tag that activity. But this has become really a clean way to see movement. And so once you get it structured in this way, what we want people to really focus on is to see how the business is moving across time. So one of our pictures is how we see it here on the summary page that we just mentioned. Go ahead and click on the P&L monthly page, Alisha. And so if you want to see variability, and this is back in history, so you have to scroll right. So you can see this on a monthly basis. Now, the thing is, it's so important to be able to see this across time, because you're going to see where all the jumpy things are. And it's going to give you insight as to, is my accounting process weak and can it be improved? Or does it really, it's okay. It's just the kind of business that's going to be that way. We take monthly, and then the next tab, click on the rolling 3 tab. We're just taking that same data and saying, okay, well, let's get it on every month ends a 3-month accounting period. So I'm a little higher quality data set that's a little smoother. And what you can start to see is you can look back in time and see what your seasonal trends are. Do you have a seasonal trend, or are you just consistently, in a upward movement or downward movement? And then the final is I can then see rolling 12 back across time. Now, the thing is, some of you will need to see this data more effectively in a graph form, and we've got graphs of this same data. And some of you really do better looking at it in numbers. I'm a numbers guy. I look at numbers and I can process those months in my mind, and my mind draws the picture. I don't need a picture on the graph, but clearly some of my clients need to see the graph. And so we've kind of given you both ways to see those movements in that process. And then the last one is the balance sheet monthly, that, as we say, that's the sheet that none of you look at, that you're going to start to teach you how to look at it. And realistically, this is the power move of this sheet. Is right there in the middle. There's a concept called trade capital. So trade capital is in essence working capital, the traditional working capital, current assets minus current liabilities, the net of that number, except it does not, our version does not include cash and does not include line of credit. The reason for that is what's left over, that trade capital, is these are all the things that turns over for your business in the normal day-to-day activity of business. AR, inventory, work in progress, accounts payable, deferred revenue, all of those types of things. Interestingly enough, I've always looked at ways to get my clients to figure out how to work more effectively with a balance sheet. And when we only looked at day sales outstanding in accounts receivable or AP days or inventory days, it was like fighting a garden that is constantly in a state of overgrown with weeds. I mean, you'd work on it a little bit, but you wouldn't make any progress. When we started looking at the net of those things, looking across the balance sheet and netting an asset with a liability, it clicked something in their head to understand, am I a kind of business that has to invest net cash to turn over business, or am I the kind of business that gets paid first and then performs? And we've got clients on both sides of that equation. What's interesting is our clients who invested cash net to turn over the next new sale, as they've seen this number relative to their net income pace, we have seen them take action to find a way to reduce that number. If I can't change accounts receivable, maybe I can get better terms from my payables. If I can't change inventory, maybe I can get paid sooner by my customers or get support from my vendors. All of those things matter. And what you find is you take a combination of elements to accomplish the task. But unless you see that number in net, you can't measure success. Now, you'll also see in this, you'll see trade capital measured as a percentage of revenue, rolling 12, also compared to profit, net income in that same percentage. What you're looking for on those lines is my trade capital percentage to revenue equal to or less than my profit? If that's the case, I'm a cash flow positive growth business. If my trade capital is above my profitability number, I'm a burn cash when I grow business. And those are important things to know, because if I grow, how do I fund that growth? If I don't burn cash as I grow, I only have one thing to worry about to grow. I just need to execute. I don't need cash to grow. And you would be surprised. The vast majority of our clients that we work with, cash is not their problem to grow. They can grow all they want if they go execute. But it's not the misnomer is, oh, I need cash to grow. No, you don't. No, you just need to be better at executing, and the cash will be there. You'll make positive cash with every new transaction. And those are things that traditional financial reporting just does not give you the insight for, in that process. So that's pretty much the overview. Like I said, we're going to plan to go much, much deeper into these in the time remaining. I want to give Alisha plenty of time to kind of guide you through. And Marcus has worked more with the actual using of the template of kind of how you connect the accounts and those things. And I'll let them, kind of weigh in on those.
Yeah, and sorry, there's some issue, a little small glitch with the internet here, so I appreciate it. And yeah, Marcus, over to you.
What's that, Alisha?
Oh, sorry, I thought we were continuing. Sorry, my bad. Like there was a small problem on my end, so I just came back in.
Yeah. No.
So yeah, I think I can see that we have some questions. Michael, are there any unopened questions that maybe Greg needs to answer, or I can just take over and give a quick demo of how to actually use the template?
Yeah, I think no questions in particular for this flow so far. I think Alisha, one though that is LiveFlow particular, LiveFlow specific. Does LiveFlow support flexible budgeting and scenario analysis? I think kicking off from there and then diving into the workflow demo will be perfect.
Okay, sure. So in terms of LiveFlow budgeting, yes, we do. So for this specific template, I don't believe we have space to add the budgets. But in general, in LiveFlow, if you are looking to generate a report that shows your budgets as well as your actuals, then you can do so using the tool itself. So I can just show a super quick guide on how this can be done. So if you are a LiveFlow customer, it's super easy. You just open LiveFlow, connect your company, connect your report, and then you just hit add budget and variance columns. And this is super flexible, so you can get data from QuickBooks if you need. And yeah, if you're looking to upgrade this specific template with some kind of budget data as well, then you can set up your own models using this as your data source. And as you connect this and plug it in, this is again something that will always be live. So if you update in QuickBooks, it will update here. But yeah, Greg, is this model something that can maybe be upgraded to include budgets?
Well, you hit on my favorite unlikable term called budget. You can hear Marcus laughing. So there's actually in both books I express my disdain of the concept of budgeting. So I call it the B word. So I'm not a fan of budgeting, to be quite honest. I'm a fan of planning and forecasting. So our internal models that we run with our clients, we take the historical piece, and we do have an area that allows us to do very quick forecasting. Probably that's something we'll have to think about. Can we reliably put that in the template and not give you scissors to run with, in that process. So let's make sure we get all the bugs and things worked out of the template and feel good about that and get through our series that we're going to teach you kind of the more details of it. But it is one of those things that we do that with our live models that we work with our clients. But we've kind of developed a way that you forecast the P&L, which then triggers, there's a handful of things you got to forecast the balance sheet. And then there's a couple of things you got to forecast on the cash flow tab, because effective forecasting has to take place of forecasting P&L, balance sheet, and cash flow, and else it's not an effective forecast.
Yeah, that's exactly right. So in terms of where LiveFlow can provide support, if you already have a budget and for whatever reason you prefer that budget, or you need the data from that budget, even if it is just to compare or improve your accuracy, then you can fetch the data. But yeah, as Greg said, forecasting is a much more complex activity. That is something that you would need to build out, but we're here to
Yeah.
provide all the data that you need to.
Yeah, and I'll give you I mean, the top level source that I learned the concept from is if you go read Jack Stack's book, Great Game of Business. I mean, that was really where I learned the concept of Jack will be the first one to tell you all of the businesses in Springfield remanufacturing holding companies, they'll do a plan for the year. And he said it goes in a drawer, but it's just a static point to measure against. You then do dynamic forecasting from every point from there. And the goal is to hit, a balanced set of outcomes of revenue generation, margin generation, and profit generation and cash flow. And part of it is you can put all the budgeting together you want. You have to be market, responsive, to that. And I wrote about in both books, budgeting is a license to spend. It's not a license to make money. And forecasting is a license to spend money when opportunity exists. If I know the relationship of what is the input to the output. And there's not 1,000 things. I don't need to budget at a line item level, in my opinion. We budget for clients at the simple numbers P&L level. We rarely ever have to get down past the simple numbers, level of that P&L structure to do any type of planning.
Yeah.
Hey, Greg, there's been a couple of questions on our trade capital, and Hassan, I think, is getting in another concept that's in the books. I don't think we showed it in the model, but core capital. Alisha, can you go over to the balance sheet tab real quick?
Yeah, I did not cover that, but yeah, good question.
So Hassan had asked the question, can you show the trade capital calculation? And then he was asking, in the book, you have added the 2 months of expenses to the trade capital. So Hassan, the core capital, I think, is what you're thinking of.
Right.
Our core capital is how much cash do we have minus what do we have drawn on a line of credit. Our core capital target is 1 month of OPEX plus 1 month of direct labor. Ideally, we want to see you at 2 months of OPEX and 2 months of direct labor in terms of how much net cash do we have in the bank. Now, when we're looking at trade capital, on the other hand, we're not really looking at the cash when we're considering that.
Right.
I like to think of it as, are we doing a good job of borrowing from our customers and vendors in the form of, can we get deposits? Can we defer some payments and have accounts payable? Or are we a business, much like a professional services company like we are, where we have to lay out all the capital up front because we have payroll to make, we have expenses to pay, and then we bill clients, and that becomes our accounts receivable. Maybe we're a manufacturer and we have a ton of inventory. That would influence our trade capital signature. And so when we're looking at those two things, they're both very important to understand, but they're kind of used for different purposes.
Yeah.
One other question Ryan had asked Greg, can you share the relationship trade capital has on the gains? I think he's getting at, what does that trade capital signature tell us? At a high level, it determines, are we a cash burner or are we a cash maker? But can you give a little more color to that?
Yeah. So if you look in the Simple Numbers 2.0 book, there's a chart in there. We call it the CPR, cash power ratio. And so if my trade capital is a percent of revenue, so let's use an example. If my trade capital is a percent of rolling 12 revenue is 10%, and my profit is at 5%, it means that the next $100,000 of new revenue that I generate over the current run rate, I've got to spend $100,000. I mean, I've got to spend $10,000 to generate that $100,000 before I get paid. But I'm profitable to 5%, so I get half of that back. So my net cash out of pocket to grow the business is $5,000 to create the next $100,000. So that $5,000 goes out before I start getting the other income in. Conversely, if my trade capital percentage is 10%, and my profit percentage is 15, I'm a cash flow positive business. Grow all you want, because every net new dollar of revenue growth produces 5% net cash. So that's the power of, I mean, that is just such a clear understanding. And Marcus can tell you, we've got clients that ebb and flow between being negative on trade capital, which means I'm getting paid before I have to spend money. And it's amazing to see businesses go from an investing first to then getting paid mindset to finding ways to get paid first and then invest and turn over the transaction. And that is such a, I mean, the banks don't like to hear it, because the vast majority of our clients don't have anything drawn on a line of credit, because we've taught them how to not need it.
Yeah, thanks, Greg. I think that was all the questions I saw. I think we hit them. Alisha, if you want to roll into kind of showing how to get the model set up. If anybody has any questions on mappings or anything, let us know. Happy to answer, or anything else we've said today.
Yeah, and just to address a few open questions on LiveFlow, I think someone asked if the template has some of the terms that Greg and Marcus have mentioned. So we do have a glossary right here, all the key terms, many of which Greg has touched upon today. And other than that, I think we had another question on budget encumbrance. So we don't currently support budget encumbrance. We support fetching the data and allowing you to flexibly manipulate it however you want. But in terms of enforcing or encumbrance, that is something that I would be really curious to kind of have a conversation on how we could achieve that in a software. So if you can reach out to us after the call, I would love to have like a product discussion on this. Yeah, and then back to the model. So the way all of these amazing tabs are working is they're just being powered by two core reports, which are pulling from QuickBooks. One is your profit and loss, and one is your balance sheet. Now, obviously, everyone has a completely different chart of accounts, and one of the benefits of using the simple numbers template is you are able to then just map all of your accounts into this very simple structure, and then evaluate all of your companies at the same level using the same lens. So to do so, I think, and to show you how easy it is to swap. So right now I have a demo company here with some very demo data, and I'm just going to go to manage reports within LiveFlow. And some of you are already familiar with this, but this is kind of true for any LiveFlow template where you can just set it up once and then scale it across your entire client base. So the first step is to connect all of your clients from QuickBooks in LiveFlow. So in this case, I have some sample ones ready. And once I am happy with what it looks like, I just come here and I change my company. So I'm just gonna go with advanced in this case. You can also swap between accrual and cash if that's if you're following the cash method of accounting.
One comment on switching between accrual and cash. We do not recommend, I mean, you can do it, but I'm not going to trust data in our model if you're getting cash basis data out of QuickBooks. You know, the QuickBooks misinterprets cash basis calculations on a pretty regular basis, because you have to process things very specifically for it to give you the correct cash basis outcome. So I will just give you that warning. If you produce simple numbers reports using the cash basis tab out of QuickBooks data, you know, do it with caution, because we believe in starting with accrual data. I mean, we believe everybody should manage their business from an accrual basis. Matter of fact, let's see, Marcus, did we put the cash basis flip at the bottom of the balance sheet tab?
I don't actually remember.
I don't think we did. So in our models, we actually manage the cash basis view by, we put at the bottom of the balance sheet the ins and outs of the cash basis formula so that our clients can see cash basis net income impact. And but yet,
We did.
yeah, so it's actually down there. You know, use that section with a caution as well, just because your accountant would have to verify what are they including or not including when they flip it on a cash basis. But it's there. That's how we see it, is we look at cash basis income from that area rather than running the model on a cash basis.
Right.
So just give that warning.
Yeah. Okay, that's a good point.
Thanks. Yeah, thanks for pointing that out, Greg. I think maybe what we'll do is include this in our template instructions. So just recommend that everyone uses accrual in this case, because we do have the option to switch, but if it's suboptimal, then we can probably dissuade that with our instructions.
Yeah.
And so, yeah, in this case, I've just switched the company and hit update and refresh report. And I recommend that you don't make any other changes other than at most. So we are going with a trading window of 5 years ending last year. You could switch this to be trailing 60 months ending last month. So if that's if you prefer having that the latest data as of last month, then maybe that's a better trailing 60-month range. But the default is trailing 5 years, so you can swap this around as you wish. You can decrease the number over here of data that you're looking at. But again, since the model by default is set up to look at 5 years or 60 months worth of data, I would recommend that you always have 60 months in there. And then once this is set up, you will see some kind of mismatch in the mapping columns. So the only thing we just need to do is paste it all back, which is super simple. And then all we need to do is go ahead and map this chart of accounts to the simple numbers chart of accounts. So I think we have these options already there in the dropdown, and you can quickly and easily map it at the parent account level, or you can go through individually and map it at a child account level. So for example, in this case, I could put this as cost of goods sold, and maybe if this, for example, was meant to be labor, so I could map this here, even though that's an item under costs, etc. So we have these options to map this as you need. So I'll just.
Yeah, and to that point, Alisha, you know, on the mapping, we don't recommend changing your chart of accounts. The reason why the mapping exists, it allows you to pick those accounts even at the account level to map to our structure, because you may have originally set up your chart under a different mindset. And we don't recommend changing that until you live with it. And this, you know, one of the things that's really helped, you know, for our process to work with clients is I don't have to do a big data cleanup project to then start giving you guidance on what the data is saying. We're just repointing it to put it in a better bucket system, but I don't need to change the day-to-day accounting of things. And that's why the structure is so powerful.
Yep. And but sometimes it's unavoidable that you might need to add or delete an account in your chart of accounts. You can't help it. But another good thing with using LiveFlow is that if you do so, like if you were to delete an account, these rows would automatically get deleted after you've removed it from QuickBooks. Right now, I've updated the setting to show all accounts. But if I were to go into my QuickBooks for this demo company right now and just add a new line item here or delete this specific line, they would really not update your model, other than you just need to come here and just make sure that your mapping is okay. And at most, it would just be mapping the new account that's come in, or if you have mapped it at a parent account level, then generally you actually don't even need to do anything. You will automatically see it updated. So it really takes away that time and headache associated with updating a model whenever your chart of account changes. So in this case, you can just go ahead and map everything to whatever is relevant based on your chart of accounts. I'm just gonna put other expenses or management labor, etc. Yeah, this is just dummy data, so don't think too hard into this. And once all of this is set up, I think some more. Right. thing to keep in mind, if we're mapping at the child account level, then don't map at the parent account level, otherwise it will double count. And I do the same here. And then the exact same process for the balance sheet. So you just copy over the mapping drop down wherever it isn't available. So I'm just copy pasting right now. And just check your mappings as well as update them. So in this case, this is fine. This probably is not what I want. Can map these, etc. So this would now need to be mapped to the simple numbers balance sheet chart of accounts, which you can see here. Okay. So, and once this would be, and once all of this is mapped, all of the other tabs will automatically update with the numbers. So I think my demo company starts having data from the year 2022, July. So I should see the same in all my tabs. Yeah, so this is the rolling 12 months. So this is only taking the previous 12-month data. And if I look at the P&L, then we can see all of our numbers flow through and update automatically. So once you've done the mapping, you can directly just jump into the analysis. You don't have to spend time checking formulas or updating anything. And I believe the graphs will update as well. Again, demo company data, I don't think I've mapped perfectly. And all of this is done, you can just finish your dashboard with your key takeaways, get a quick summary. We also have some options to change the number of months you're looking at. But as Greg said, it's probably best to keep this as a 12-month summary. But we have the option to change it if you wish to. So it's really flexible and supports whatever kind of analysis you wish to do. So yeah, I'll pause there and see if we have any questions. Okay, I don't see any open questions, so.
Alisha, we have one question actually going back to the cash flow tab. From Hassan, as an entrepreneur, we are always looking at how much cash is available. How would you recommend using the cash flow tab and just making the most of that in an effective way?
I think this is for Greg.
Yeah, I mean, so from that tab, I mean, what you're really looking at, line 32 is kind of telling you, oh, I would kind of look at that line and see the ebbs and flows of, am I constantly producing positive cash flow from operations, or am I jumping around? And so that's kind of the line that tells you kind of, is my cash reserve sufficient? If you're a fixed asset heavy business, I'm going to look at line 26 to make sure, am I purchasing fixed assets that I've got to have a mindset of saying I've got to have enough profitability to eclipse that appetite for equipment. So EBITDA might be a good measure from a profitability standpoint, but if I have a heavy equipment, depreciation becomes a real number, at some point. And so you've got to pay attention there. And then when you get into the financing, you're looking at, am I borrowing money? Am I on and off the line of credit? And more importantly, kind of the due to, due from shareholders and the distributions line is the next major line of saying, the classic issue that entrepreneurs face is, I'm profitable, but I don't have cash. Well, if that is your question, the first place I look is line 38, and I look at distributions. And so usually if you're profitable, but you don't have any cash, you're the problem. And so you've got to go on a distribution diet until you hit the right cash number, and you only take distributions when you have excess cash over your too much cash number. So you have to kind of develop a discipline of, I don't spend cash that I have and then try to replenish it. I only spend the cash personally for consumption or other outside investments when the business generates excess cash. And you got to flip the script on that, in that process. But that's how we use it most of the time.
Yeah, and I will say, when we're working with our clients and we are working on the forecasting and everything, I mean, the cash flow impact of what the forecast tells us is a big part that we cover. Like Greg mentioned, when we're talking about trade capital, if we're forecasting a tremendous amount of growth over the next couple of months, and you're a company that has a positive trade capital signature, you're profiting less than your trade capital needs are, you're going to need to have access to outside funds or some cash on your balance sheet in order to fund that growth. And so we make sure that we bring those things up proactively so that nobody's surprised when, hey, we sold a big contract. Unfortunately, it's on 90-day terms, and I have to lay out a couple of $100,000 just to support it before then.
Yeah, a good example. I've got a client right now that has a distribution habit that's not good. And I have to give them targets of saying, hey, you're below the equity requirement of the business, and I need you to go on a distribution diet until we build back equity to their target number, because they've got their busy season is right now, but a lot of the cash that they have is because they do collect cash from their customers and hold off paying their vendors, to where their trade capital is negative by as much as $1 million at a time. That means that there's $1 million of their cash that's not theirs. That's dangerous cash to take out of the business. That's not yours. You need it later.
That's very well explained. And I think, so this model currently is only looking at actual data. So as Greg said, once we dive into the forecasting side of things, which I believe we'll cover in later webinars with probably a real company or maybe a sample company with more relevant data than our current randomized one, it'll be a little more relevant to see how your actual cash flows project out into your forecasted ones. But yeah, this is the current. Sorry, did I interrupt someone?
Like I said, we'll go into more detail in some of the nuances in some of the future, webinars that we'll do on it. But it's a, hats off, Alisha. You guys have done a great job of putting this together, because we attempted it in a way that was not nearly as effective. I mean, so this is really just great work on y'all's part. So we really appreciate it.
Mm-hmm.
Pleasure for our Craig. This was such a nice model to build out, and we're so happy to partner with Simple Numbers, because this really elevates the quality of data that people are analyzing. So
well, you use my favorite word, elevate. So my purpose, my words is elevate the entrepreneur, and I think this is a tool that definitely elevates the entrepreneur and their ability to understand their data in a much more effective way than traditional reporting.
Yeah, for sure. And yeah, and in terms of everyone who's attending here, so LiveFlow is currently working on a lot of different smaller projects, and we're always looking for beta testers. So if any of you are more interested in the product side of things, and you would like to take part in some of these programs where you just test out certain new features before we release them and give us feedback, then we'd be super happy. And yeah, I think we can just drop that link in the chat if anyone would want to, just if anyone wants to participate in this program, you can just reach out to us. So I saw a question: is the tool adopting rolling forecast model? So the tool itself has rolling. So if you're talking about the context of this template, then it's kind of pre-built, where we look at rolling 12 and rolling 3 months for all of these dates. But if you want to create a separate report for yourself and you just want to look at any trailing period at any time, so maybe it's more useful for me to show it to you in a separate sheet.
And I'm going to have to drop off, so I'll let you guys finish up, and really appreciate you guys having us.
Of course, likewise.
Thank you so much, Greg.
Thank you.
Yeah. Okay, yeah. So I'll just quickly show a quick demo of the rolling feature, and then we can wrap. Yeah, so if you have any period, you can just choose your date range as a trailing window or a rolling window. So if you want a trailing 12-month period, this is just the default. You can change this. We support week, month, year, etc. You can generate it, and it just takes a few seconds to generate the report. And we also have a rolling window where you can start and finish a specific number of days or months behind a reference date. So I just create this report. And then, but I use the same settings, but essentially this is how the rolling feature works within LiveFlow. Okay.
All right. Well, great. Well, thank you so much, everybody. Yeah, really, really great webinar. I hope that everyone was able to get a lot out of this. I think that from the chat, from the response, yeah, I think this was very valuable for everybody. And again, just a reminder, this is just the first session and installment of the Simple Number CRA LiveFlow webinar series. So keep an eye out for this recording, as well as an exclusive link to register for the next event. We'll make sure that everybody who's on this webinar now has exclusive first access to that, to make sure that your seat will be reserved and safe and sound. But yeah, thank you so much, everybody. Thank you, Marcus. Thank you, Alisha. Greg, again, thank you, even though he's not here. But yeah, we look forward to seeing everybody soon. If you have any questions, please feel free to reach out to us. Please use the links in the chat. And we look forward to seeing everybody the next time. Have a great rest of your day, everybody.
Thank you.